Quick note before we begin the episode. Episode 200 is fast approaching, and to mark the occasion, Hussam and I will host a special Q&A session with questions from you lovely treasurers. Click on the link in the show notes to submit your question, and we will even send a $10 gift card for our favorite 5 questions. It can be about careers, treasury, corporate treasury 101, or even what Hussam's favorite ice cream flavor is. Deadline to submit your question is December 15th. Have a lovely episode. Welcome to the Corporate Treasury 101 podcast. In today's episode, we discuss FX risk management in Latin America and much more with Matheus Zani from Deaglo. Matheus Zani is the head of FX risk management at Deaglo. He holds the distinction of being the company's first employee, having joined in 2020. With numerous years of experience in consulting roles, Matheus has a proven track record of collaborating with companies across Latin America. Deaglo is a fintech firm that offers FX risk management solutions to institutional funds raising foreign capital, investors relocating overseas, and corporations expanding and operating globally. In the episode of today, expect to learn what are restricted currencies and how do they impact financial activities, what challenges do businesses and investors face due to currency restrictions in Latin America, and how do these restrictions affect trade? How has the FX risk landscape changed in Latin America over the last decades? What are NDFs and why are they popular in Latin America? And like always, much more. Latin America is a fascinating region, especially when it comes to treasury, cash management, and of course, FX risk management activities. And we got to talk with an expert of the region. We truly hope you will enjoy this episode. If that is the case, and when you're thinking about how you found our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform. And this is our only request to you. The best way you can support the podcast is to head to YouTube and subscribe to our YouTube channel, Corporate Treasury 101. That would mean the world to us and help much more people to learn about treasury. On another note, this episode is brought to you by Automation Boutique. Automation Boutique is empowering treasury, finance, and risk management with tailored automation solutions. They use robotic process automation, or PA, AI, APIs, and Power Query to create automations that can work with your existing systems. We partnered with Automation Boutique as we really like their approach to innovation and how they help the industry. For this partnership, they came up with an AI-powered automation self-scan that can help you find out if a business process is suitable for automation and how to best get started. It is totally free, non-intrusive, and only takes about 15 minutes. What's great is that the report you will get from the scan helps you determine if the benefits of the automation outweigh the costs. If you want to have a look, head to the link in the description or to automationboutique.com/corporate treasury 101. With all that being said, please welcome Matheus Zani. Matheus, thank you so much for joining us on the show. Can you maybe start by explaining to us what exactly are restricted currency? What is it and why do they exist?
No, for sure. No, first, thank you for having me here today. It'll be a pleasure to share a bit of my experience with the whole audience. Regarding your question, restricted currencies are foreign currencies subject to government-imposed controls, pretty much. So often to manage capital flows, preserve foreign exchange reserves of these governments, or this currency can be impacted by the monetary policy of these governments. So pretty much it is actions from the government side that can impact the currency value of the currency pair.
So why would the government? That's interesting. Why would the government want to preserve the foreign exchange reserves of its country? Like, what's the interest for them in doing that?
That's a good question. And to answer you, I will give you a couple of examples. Let's use Latin America as the example here because it's the purpose of this interview. No? In LATAM, some of the restricted currencies include the Argentine peso, Venezuelan bolivar, and occasionally the Brazilian real. Okay, I can mention these three currencies. And the government of these countries, they use this kind of actions or policies to preserve the foreign exchange reserve. Or they want to use this to preserve the value of the currency of that country. Okay, most of the time against super depreciation against the dollar. Okay, so or if you look at the inflation side as well, the government uses these policies to try to cap the inflation impacts. A good example of that, Argentina and Venezuela. Argentine peso has limited access to foreign currency, mostly because the hyperinflation. Now, I think we can explore this later in this interview. Argentina has, I think, more than 120% of inflation, which is quite high. And Venezuelan bolivar is pretty much the same. So both currencies face extreme exchange rate volatility, and the governments, in order to bring down this volatility and also to combat the negative impact of the inflation, they use these actions, they use these policies to manage the currency value of the currency.
Super clear. So if those governments wouldn't be restricting their currencies, they would be a bit open on the market, right? And if any country wants to purchase some of those governments would have to issue more money, leading to easier inflation rates and more volatility. So it's a kind of way to mitigate that. Super interesting. So I think you mentioned 2 or 3 of them without maybe going to all the currencies in Latin America, but typically what are the big currencies in Latin America? Because indeed the idea is a bit to focus on this region. Which ones are considered restricted? And then what are the challenges that come with that?
Yeah, as I mentioned, I think on top of my mind, I'd say Argentine peso, Ecuador. Ecuador is slightly difficult because the Ecuador adopted the dollar as official currency in 2000, exactly in order to stabilize its economy. But I think the hottest currency now that I can say that's completely restricted currency is Argentine peso. Very recently, the Argentine government implemented strict controls on the FX. So in order to companies and business to access this liquidity has been quite difficult. So business that, as you know, Argentina has a very large exporter background, so exporting cereals, cattle, and so on. So in order to this agro business to converting dollars to Argentine pesos is quite difficult. They have limited liquidity, and the opposite is the same as well. For Argentine important companies that want to do the acquisition, to the purchase of some goods, it's quite difficult. It's quite difficult because they are not able to convert the Argentine peso to US dollars. So they have some limitations per trade, limitations per week. So it's not fully open. Yeah, you need to respect the regulations of the central bank of the country. I think then currently Brazilian real, Mexican peso, Chilean peso, Colombian peso, I think we can say they are off this list. They are much more open in the FX market. You have a plenty of liquidity. The central banks, they are very solid entities in those countries. So and they are very pro-business, pro-market. They don't want to put barriers or obstacles in the currency because they know the negative impact that can generate in their economy. So I think for now I would stay with the Argentine peso and the Venezuela bolivar.
So when countries have these restricted currencies, how does that affect the foreign investment market? So say I'm a corporate inside a country that has a restricted currency like Argentina or Ecuador. How will that affect the type of investment that I'm likely to get or the trade I can do externally?
That's a good question. I believe the international investor, either family office or other governments or large fund managers, they do a very strict due diligence in that country, the destination of the investment. They need to understand the regulatory framework of that country. They need to understand the political risks. And right now, more and more, we are seeing that the checkbox of currency is one of let's say one of the most important components when investing overseas in those countries. Because first, you can have a large depreciation. So you allocate your capital. Let's say let's use Brazil real as a good example. Let's say that you allocate your capital into a 5 reals per dollar now today, but we know there's a long-term investment. So let's say 10 years, 5 years is a very large horizon to make the gain of the capital and make this investment profitable. But the risk is the currency first, a depreciation of the currency against the dollar. So this BRL can jump from 5 to 7 to 8. So just in this depreciation, you have like a large losses in your investment. Second, in other countries, you can put your capital in the country, but you're not able to remove this, to bring it, to move away of this country. So that's very difficult. There's a very serious implications that all investors must to have in mind. This happens quite often, not in LATAM, but I would say Africa, countries such as Nigeria. We have seen that a lot of businesses are struggling to collect their dividends from the companies in Nigeria, or if they plan to do some exit, they're not able to collect the value of the company that they sold. So there's a lot of implications. So these managers must do a very large due diligence, very serious due diligence to grab the big picture when investing in those countries. And FX risk has been, I think, one top 3 of the concerns of these international investors allocating in LATAM or in general emerging markets.
So from the corporate side, you need to watch out if you're sitting inside one of these restricted currency zones that foreign investors are less likely to come to you or have all these other considerations just due to the fact that you're operating in a current or in an economy that has that currency, right? What about the other way around? Like for a corporate inside that country that has that is operating in Argentinian pesos, for example, how does that affect their business operations day to day? Like, I guess locally it's a very different a very different scenario versus internationally. So an Argentinian steak company, because Argentinian beef is super popular, how do they need to? What's different about their business operations versus a US steak company?
They need to be much more sophisticated, much more creative in order to address these implications, the negative implications. As I mentioned, for an importer that has a liability in foreign exchange in dollar or in euro, they need to have a very good planning in order to pay this liability. Okay, why? Because tomorrow the government can say, now have all companies of this country must have the right only to buy $100,000, but your liability is $1 million. Okay? How will you be able to pay this liability and avoid any kind of default? So must be creative to have like offshore entities set up with some dollar reserves be able to access offshore liquidity, able to have relationship with different counterparts. This is another way to diversify your treasury, because you'll be able to find liquidity from different counterparts. This is one of the good strategies. But yeah, I'd say in general it's quite difficult. It's quite difficult to be able to address all the negative implications. I'd say that, and also have a very solid team able to run more accuracy cash flows, taking consideration this volatility of the market, not only the currency, but the actions of the central bank. It's not easy at all. It's not easy at all. We haven't seen more and more Argentine companies trying to escalate their businesses. But in order to escalate their business, first they need to structure some offshore structure to access other markets, and also able to create this bank relationship. But they struggle in the fact that because they're from Argentina, they don't have that high quality of credit. The counterparts run their models in terms of credit, also penalize just because it's Argentina, because they are aware. They are aware of the central bank actions, the government action, mostly in the top of that. So it's quite difficult. It's not easy. It's not like a country like Brazil or Colombia or Mexico, where they are much more open, they are more transparent. The political risk is still there, but it's not elevated as such as in Argentina, Venezuela, and so on. So it's easier to make business when you have this environment of lower currency risk, lower political risk, economic risk, and so on.
Super clear. Is there a general trend that you see going on restricted currencies? Like, is it across LATAM, if we focus there? Is the situation getting quote unquote better or worse in general, or is it just very unique country?
I'd say it's very unique country by country. Let's say Mexico. Mexico has generally maintained a more stable currency or currency environment, I'd say, over the last years. We have seen that they have an international policy much more open, and again pro market, but it's essential to monitor the peso's performance as economic and political events can influence its value. Mexico has a longer history of political conflicts. Political agenda is not that clear, so that can have a direct effect in the value of the Mexican peso. Other example, Chile. Chile is the same thing, very relatively stable, but fluctuations can occur due to the factors like copper prices. So one Mexican is more political, Chilean peso is more related to the commodities. So it's a commodity linked currency that we say here. So if the copper prices it's higher, this can help the Chilean peso. And on the other hand, you see the copper price is lower, the currency can be seen in a position of weakening against the dollar. Peru, the currency of Peru is Peruvian sol. So, sometimes people think it's a Peruvian peso, but it's Peruvian sol. Has experienced some volatility in the past as well, mainly due to political situation in the country, and it's not that in the past. It's recently, in the last 2 years, we saw a lot of negative implication due to the political environment. So it's important to business to monitor the political landscape, mainly in Peru. Brazil, in the past, I would say it was a restricted currency, but nowadays it isn't. Completely free floating. But of course, still have some influence by the political economic factors. I would say that the second one, the economic factors, is a huge one. Okay, so government interventions, along with economic development, they have the power to stabilize the currency or do the opposite, to increase the volatility of the Brazilian real over the time. Ecuador, as I mentioned previously, Ecuador adopts the dollar as its official currency in 2000 to stabilize its economy. We have a similar discussion right now with Argentina as well. If I'm not mistaken, the opposition right now, because we have presidential elections coming, they are discussing how to adopt dollar as the main currency in the country. They have, of course, they have a lot of theory, experiencing behind of this proposal. Mainly because when you start using dollar, you may be able to address the high inflation. Because in Ecuador, Ecuador was very successful adopting the dollar because we were able to reduce the inflation, but it's not true at all the times. Okay, so yeah, I'd say each country has your unique challenges, your unique policies regarding the currency.
Looking at it a bit from a corporate treasury and global standpoint, one of the challenges I see with those restricted currencies, and where it's particularly impactful for treasurers, is when it comes to credit lines of any sort, right? Because especially big organizations who are often looking for a global banking partner for the whole region with one big revolving credit facility, for instance. In Latin America, the challenge that you need to look at each country individually, also what are the capacities of the country and the bank itself when it comes to credits, because some banks might not be able to provide you as a company with as much credit as you want, not because you don't have the right credit rating, but just because the currency is so restricted that they cannot issue such a big credit line. So it's an interesting challenge to tackle when you're in corporate treasury. And also the interest rates vary, right, between each country, making the whole credit part of an organization wanting to do business in LATAM much more intricate, which is super interesting. So yeah, sorry, what's your opinion on this, Matheus?
No, you are completely right. Mainly in the interest rate. Right now we are in a period of, I'd say, almost all Latin countries are suffering with inflation, high inflation, and to address that, all the central banks start to hike rates. So as a result, we have increased borrowing costs, which from the corporate side, they face a lot of challenges regarding how they can restructure their debts with a cheaper cost, but it's very difficult in such environments of high interest rates. One alternative to that in the past was to issue foreign debt, mainly from USD like that, but now it's also expensive offshore. You have Fed rates around 5.50, and in Europe more or less the same situation. So has been a very challenging market environment right now for those that depends on credit, either domestic or offshore credits.
Yeah, exactly. And so how is this, that's a perfect transition. How is this inflation in Latin America overall, how does it affect treasury activities beyond the obvious example of the credit lines?
Yeah, I would say for companies that work in the retail sector, inflation can change very rapidly the cost of the good and also how they sell it to the retail buyers. So this environment of the high inflation, very volatile inflation, adds a lot of complexity in the treasury for all the departments of the company. The buyers, the sellers, the pricing team, and of course, the CFO that manage all the cash flow of the company. So high inflation is a very it's a very difficult component to quantify in terms how we can work with these numbers and maximize my cash flow in terms of maximize my profit and reduce my costs. It's very, very, very tough to deal with inflation. And the result of the inflation is, as we discussed earlier, is the high interest rates. High interest rates will lead to a higher borrowing of costs. So companies not only need to deal with the inflation in one point that is sell their mercancy, but also how to manage their cash flow in terms of liquidity of the company, how much I need to finance my liability in order to have a cash flow, a proper cash flow of the liabilities and assets at the same bottom. I think this is the idea.
Yeah, makes a lot of sense. So maybe going a little bit deeper into navigating the foreign exchange landscape in Latin America. How does each country there differs in terms of its currencies regulation and challenges? What have you seen there?
Yeah, indeed, Latin America countries exhibit very diverse currency regulations and challenges. For example, Brazil is as one of the largest economies in the region, has its own unique currency, the Brazilian real, as mentioned here many times already, and a very complex economic environment. In contrast, Argentina has faced a recurring currency crisis in the last year, very strict capital controls. Chile, on the other hand, has more open and stable foreign exchange market, make it distinctive from its neighbors. But yes, each country has your unique situation. We cannot, in any possible way, to generalize all the environment of the Latin America. It's just one sort trend or just one sort regulation or gen. Each country has your unique situation.
And I guess the FX risk management, again, coming back to the effect of that for treasurers and people doing treasury operations, Matheus, people look at LATAM as just LATAM, right? It's South America, or Latin America. But if the situations are so different in terms of currency control and regulation, is the FX risk management for that also very, very unique? Or like, can I... In one sentence then, right? My question, one sentence. If I'm a global treasury manager, right, with a company that's working in all the different regions in the world, can I realistically divide up the world into LATAM, USD, Euro, and Asia? Or do I need to, if I'm doing business in multiple areas of LATAM, do I really need to have a very specialized, tailored FX risk management strategy for each country I'm operating in LATAM? Or can I generalize? Or is it as different as doing business in Argentina as it is in Peru, as it is in the US versus Europe?
Yeah, that's a very good question. No, I think you cannot generalize your FX risk management approach. I think each country has different market environments or market conditions. So we need to take this in consideration to put together a very solid FX risk management program. Why? Even though all the derivatives are the same in superficial lines, I want to say we are able to access liquidity for NDF, which is a non-deliverable forward. You have forwards available, options available, cross-currency swaps. In general lines, you are able to put together a hedging strategy using this instrument. But how you deploy, how you build this hedging strategy, you differ country by country. Okay. For example, I cannot, let's say, book an ETF for 24 months in Peru, but I can do this in Brazil. Why? Because in Brazil, the market is cheaper than in Peru. Okay, so we need to understand this liquidity, how far I can go with my hedging strategy. Or another example, I can place options. I can buy vanilla call put or some other option structures in Chile, but I cannot do this in Peru. The same thing. I don't have liquidity for these instruments. In Brazil, I may be able to go 24 months, 18 months out using options or using a cross-currency swap. But we need to understand how expensive it is. Maybe it's cheaper to do a short-term hedging and roll over the position to match the effective cash flow. Because you will be able to minimize your cost doing short-term hedging rather than long-term hedges. Okay. But in Colombia, I can go 24 months and it might be cheaper than in Brazil real. So, of course, this is market condition that can vary every single day. But these nuances that the treasury team must be aware. The instruments are the same, but the market conditions are completely different. Each country has different volatility. Each country has different treasury rate differential. Each country has different liquidity to access this product. So, in the end of the day, what you are doing in country A, you'll be very, very difficult to replicate for country B or country C. So, each country has your unique market conditions, and therefore you have a different risk management program and approach for that country.
Have you been doing this for a decent amount of time now, Matheus? Do you have any good examples of FX risk management strategies you've seen implemented in this region? And it would be interesting if you give examples specifically on the dangers of generalizing LATAM versus the successes of specifying your FX risk management strategy across different countries in LATAM. Do you have any examples you could share with us of success stories?
No, for sure. I can say mainly in Brazil where our clients are based right now, because we have such a high interest rate differential, which is a higher hedging cost, that deploying NDFs to hedge the currency risk can be quite expensive for those firms that need to be long dollars and sell Brazil real. So we performed many analysis simulations here where we were able to showcase that hedging through NDFs will be much higher while hedging with option structure would be cheaper. Because the way that options are priced takes into consideration three main components. The first one, of course, is the interest rate differential. The second one, the volatility of the currency pair. And the third one is the time to decay, the time to the maturity of the contract. So when we analyze NDFs, the first component is the only one that price NDFs, the interest rate differential. Okay, so if you want to hedge for exposure 12 months out, using NDF is much the cost will be higher when hedging through options, because it's the three components. We can try to optimize the strikes of the options and the same time that we are able to cap the downside risk, optimizing the strike, we're able to have some upside participation. Of course, depends on the option strategy, but options offer this flexibility to manage the currency risk. And so because we are able to have this upside participation, and with the downside risk capped, we are able to reduce the hedging cost. So this is one of the main points. And another advantage using options, because they are less sensitive to market. So let's say if the currency change 10% with the NDF you show 10% mark-to-market, negative mark-to-market. But with the options, will not be the same thing. Okay, so for those companies, businesses that face some liquidity constraints, options are a better alternative solution, okay, rather than using NDFs. So as I said, also depends. We need to understand the risk profile of the client. We need to understand the goals in this hedging program that the client wants to build. And at the end of the day, the hedging strategy will be completely tailor-made, taking consideration the market conditions and the risk profile of the client.
And that's an interesting one, right? And we understand that it's a bit hard to pinpoint a failure in FX risk management in Latin America, but one of the things I can think of is typically the idea of FX management is to mitigate the risk, right? But when you are in the case of a country in Latin America where you have particularly high inflation, it also means very high volatility in your FX rates, right? So you can be hedging, but ending up having an ultra negative mark to market because you could have made so much more money not hedging. The other one I can think of is when it comes to credit lines hedging. Typically, corporations might be interested into hedging their liabilities in Latin America, right? As a European company or an American one. Here again, to just make sure, okay, we need this credit line in Chilean sol and not peso. We cannot circumvent it, but what happens in case Chilean peso goes through the roof or the other way around? And here again, it comes down to how well and how much do you want to protect yourselves against such uncertainty, right? But a super interesting one, Matheus. Thanks a lot for that. You've touched upon it a lot, so let's dive into it. Can you quickly remind what FX risk is for our audience? So just disclaimer, we've done quite some episodes lately around FX, but just a quick reminder, and try to explain it if possible within the Latin America context.
No, it's always good to revisit some terminology and approach. Pretty much FX risk is the potential loss, but also the potential gains that a company may have and may experience due to the currency fluctuations. I like to say that risk doesn't mean only it's a problem. The risk it's not only your enemy, but you can take advantage of the risk. Risk can make your revenue more profitable, or you can see your revenue lowered due to the currency fluctuation. So currency risk is both. Is the potential loss that you may have due to the currency fluctuation over the time, but also potential gains due to the currency fluctuations over the time.
Crystal clear. And so why is foreign exchange risk management such an essential part of corporate treasury when it comes to Latin America? Like, obviously we've teased and talked about it already, but can you summarize why it's so essential in this particular region and how it differs from other regions?
Yeah, I'll give you a very clear example. If you take the Brazilian annual volatility in the last 12 months, it was around 16%. If we run a volatility risk at a 95% confidential interval, in a cash flow, let's say $100 million for 12 months, this volatility risk will be $26 million of losses. Okay, so in a portfolio, a cash flow of $100 million, your potential loss will be 26% of this amount, which is huge. Okay, we don't have the same currency volatility in the developed markets, even though it's getting higher, but it's not that higher when compared to emerging markets such as LATAM. So Brazil real 16%, one of the most volatile currencies in the world. Colombian peso 15%, Chilean peso 12%. Okay? So all these major Latin currencies shows higher volatility, and high volatility can translate to higher currency risks. So this is the idea. So because that is so important, business with exposure to FX risks to have a very solid FX risk management program. The main goal is to reduce this currency volatility in order to reduce the fluctuations in their cash flow. Pretty much this the idea. The essence of the currency risk is to reduce the currency volatility over the time. Okay, so when we reduce the volatility of the currency in your cash flow, you have more stable revenues, you have more stable liabilities, because you don't have more higher impact of the currency on these exposures.
So when I think about and understand all this complexity in Latin America, are corporations not just tempted to say, okay, well, if it, I'm just gonna deal as much as possible in dollars? You mentioned, I think Ecuador started using the dollar as one of the main currencies, right? I believe Costa Rica is the same. Is it a possibility for corporations to just say, okay, guys, if, I don't know, 90% of my suppliers are anyways not Latin America based, but will probably accept dollars, let's deal like this and try to convince my customers to also deal in dollar? Is it a practice in Latin America or not at all?
Yeah, this can be done. This can be done. We have seen many corporations adopting this practice. What they are trying to do is to seek a natural hedging. So their supply chain is in dollars, their buyers are in dollars. So we don't have any currency risk, any currency mismatch. So this is a good practice, but not always this is possible. Not always this is possible. But when this is possible, of course, it's a good strategy, because we don't need to build a hedging problem to address the currency risk. We don't need to build an in-house team or outsource this hedging to a FX risk consulting company and so on. It has good advantages, but in some cases you don't have this opportunity to do that, or your customers are not be happy with this. They want to pay local currency. They need to pay in the local currency. So in order to gain competitiveness, you need to work with the local currency of the country. A good example of that is SaaS companies. When they try to be more international, they want to commercialize them to sell their SaaS software, their SaaS products in other markets. They need to charge the client the license of the product in local currency and not in their basic currency, the reporting currency. Okay? So when they charge their customers in local currency, generates the currency risk. So they need to manage this currency risk.
This has FX hedging changed over the years. Like, so options aren't a new technology or a new, let's say, financial tool. Technology has changed quite a lot, nonetheless, though, over the last 10 years or so. How have you seen the evolution of just hedging as a technology or as a strategy become more complex or versatile or adapt or progress over the last?
That's a good question. And so what is it? So a good example of this movement towards innovation is Deaglo. We are not a traditional FX consulting firm. We are using a lot of technology in your approach regarding currency risk. We are adopting a lot of machine learning, Bayesian regression, and now AI in your tools. So the idea of Deaglo is to take a more holistic approach to FX risk management, in particular in emerging market currency, due to all the factors that I mentioned here, volatility, interest rate differential, in order to provide a more tailor-made solutions to our clients, and always using technology. This is the idea. So because that, I don't like to say that we are advisory. We lean more to be a fintech. Okay. So this in the last 3 years, we have been developing a couple of tools that right now is in a platform web-based where our clients can access and use our tools there. So there are many things that the users can do in your platform. The first one is to gain access to market data, trends, analysis to take a more effective decisions. They are able to use Monte Carlo simulations, which is a very sophisticated statistics technique, né, to model potential outcomes of the currency pairs. He is able to incorporate inputs like volatility, skewness, amount, maturity, and the platform will bring different outcomes because different market conditions. Because as you have flexibility in the inputs, like change the volatility, change skills, you are able to create different market conditions and analyze the performance of different hedging programs in such environments. So most of the time we create the clients create three market conditions: worst case scenario, neutral scenario, and best case scenario. So through the platform, he's able to see, okay, this hedging strategy performs in this way, in this environment, in this one. So, okay, I need to protect against the worst case scenario. So I want this one because my risk profile, I have this profile. So this one is the best hedging strategy according to my risk profile. So in this way, he can see the statistical evidence and take a more formal decision. The bigger it is to remove the emotion of the trader, remove the emotion of the treasury team in terms, okay, I need to use an ETF, or no, I need to use this because the market goes to 7, 8, 9. No, the idea is not that. The idea is to remove this and apply more data-driven decisions into the treasury team. This is the idea. So using this innovation, using this new approach to FX hedging, the clients can put more solid hedging programs in place, be able to maximize the upside participation, these hedging programs, able to reduce the downside risk considerably. And in the end of the day, doing all this with a lower cost because he is optimizing all the steps to build their hedging structure.
So technology overall, such as actual computing, the rise of fintechs and whatnot, would you say that's the biggest change in FX risk management over the last decade?
Yeah, I'd say. And right now with AI, I think things will change completely. We are seeing more and more companies and also FX specialists adopting AI to run analysis, simulations, and the good stuff that we can, all the technology can expedite the hedge analysis. This is the build. We can expedite the analysis and be comfortable with the results. The accuracy of the numbers of the results is much higher when you have a machine running, you have an algorithm running the simulations, rather than some member of the company doing Excel, spreadsheets, endless data to analyze, etc. So I think machine learning, AI, all the technology, all the developments in this area is towards how we can create better FX risk management strategies. More accuracy, I think the word is accuracy. How to reduce the noise in this analysis. How to make sure that that strategy will work in that specific country, which has that specific nuances in terms of volatility, interest rate differential, hedging cost, liquidity of the instruments, etc. So using this technology, we'll be able to put together much more solid FX risk management programs.
Awesome. So this you mentioned earlier a term, NDF. Could you explain NDFs? Like what are NDFs and how do they work?
No, for sure. NDF stands for non-deliverable forwards, which are derivative contracts designed for hedging currencies in markets with limited convertibility. They operate as agreements between two parts, typically a company and a financial institution, your counterpart. So you exchange the difference between the agreed upon forward exchange rate and the prevailing spot rate at maturity. So pretty much is that you exchange the rates. And also another feature is that NDFs don't involve physical delivery of the underlying currencies. So this is the main feature. So it makes NDFs ideal for managing exposure to non-comfortable or restricted currencies. It's a big advantage.
Okay, so that would mean if I contract an NDF with you, Matheus, for like, I don't know, 100 million Chilean sol, at maturity, the value of the sol would have been 120 million. You will only transfer me 20 million. Basically, that's what it means. You will not send me the whole contract. You're just sending me the difference, correct?
Yes, correct. It's only the difference. In the settlement, you have the P&L, the profit and loss. So you'll be receiving the profit or paying the losses to the institutional counterpart. But it's exactly as you said. It's just the difference between for the rate against the rates at the maturity.
Super interesting. And so why is that particularly relevant when we look at a restricted currency?
That's a good question. NDFs have gained prominence in LATAM for several reasons. And so first, they provide flexibility by allowing business to hedge against currency appreciation or depreciation. Of course, is the main reason. Okay. Second, NDFs can be cheaper than option strategies or even forward contracts as well. Okay. I mean, just from the transaction cost perspective and not the interest rate differential. This is another thing. Also, NDFs contracts they are off-the-shelf products in many financial institutions in the region. In other words, companies can find them in almost all banks across the country. Banks are very used to offer NDFs to their clients because they can find NDFs has a huge liquidity in those countries when you compare with forwards. Also, NDFs you can go far regarding the tenor of this contract. You can place 6 months, 12 months tenor. When you compare with forwards, most of the time you are not able. The banks cap your tenor to 30 days, 60 days maximum. Because as you said, NDF you need to pay just the difference. While the forward you need to do the whole amount, which means it's more riskier from the counterpart perspective. So because that NDF is more popular, more traditional product in such countries.
So it's cheaper, it's easier to deliver, it's less risky for the bank. I'm gonna put you a bit on the spot here, Matheus, no pun intended, but why would all the companies not use NDFs all around the world? Why is forward even existing then?
This is a good question. When we look at the developed markets, Europe in general, along with the UK, US, Canada, they tend to use forwards harder than NDFs. I think pretty much because the risk of these contracts. I think the counterparts see that these developed markets less risk to offer forwards harder than NDFs. This is one thing. And another thing is because just the difference. So that allow you to I think it's the same. This is a good question. I need to investigate this a bit better. But if you go to Africa, all emerging markets, you see the NDF being used much more than forward. In Brazil, we can use it forwards, but as I said, it's just for short-term hedgings, and NDF for long-term hedges. And each one we compare the pricing. There's a large difference in pricing for those instruments.
Okay, and I see. So looking on the internet of all things at the same time, it seems that NDFs can also be. I mean, the NDF markets are also focusing on certain currencies. So maybe that's a product that is developed by certain financial institutions only in particular countries. The ones I see here are Chinese yuan, so typically a restricted currency, Indian rupee, South Korea won, New Taiwan dollar, Brazilian real, Russian ruble. So that's maybe why as well. Actually, the NDF product in itself is made more available for those currencies. Maybe forward is more profitable for financial institutions than NDFs. But anyways, a good follow-up question, definitely. Thanks a lot for this, Matheus. So are there specific countries or scenarios where NDFs are more advantageous in Latin America in particular? I think we've built up to this point, so the answer is quite obvious, but can you enlighten us on that? In Latin America specifically, are there countries where NDFs are more advantageous, if not mandatory?
No, I would say there isn't a all-fits answer here, because the most adequate instrument will depend on the market conditions, as I mentioned before. And so if you use, for instance, Mexico, Colombia, Chile, and Brazil, all these countries, you are able to put together your hedge strategy using NDFs. Okay. But that doesn't mean that NDF you be the most adequate one. You depend a lot different components. As I said, the risk tolerance of the business and the hedging cost. I would say the hedging cost is the most important component that you need to understand when you are building a hedging strategy. So NDFs can work very well in a specific market condition, while options can work very well in another specific condition of the market and different risk tolerance. Okay? So I think the businesses, they need to understand these components and try to identify what is the best instrument to them. How they will approach the currency risk and the strategy they'll be using, you depend a lot of their budget, their risk tolerance, and so on. So I will not say that NDF is the best one in Mexico or the best one in Brazil. No, depends on the market conditions and the profile of the business. And at the end of the day, what do they want to protect? How much they want to protect it. I think this is the idea.
You mentioned a couple cons about NDFs earlier, but there's any others that you didn't list? Any other reasons why you wouldn't use NDFs, even in LATAM?
No, I think
and you would use a forward, for example?
Yeah, usually we are seeing clients using forwards for short-term hedgings. Okay, 30 days or 20 days, maximum 60 days. They use it for tenors higher than this, 6 months or 12 months or 1 year and a half. They tend to use NDF or option strategies. See, in terms of flexibility.
And are NDFs not good? Are NDFs not good for short term, or forwards?
Yeah, it's a good question. Businesses tend to use forwards because it's easier to set up this instrument with the counterpart. Okay, but sometimes for an NDF, the business must to set a ISDA and also a credit support annex with the counterparts. Okay, for forwards, most of the time they don't need to do this paperwork. They have a relationship with the bank. I want to book a forward, and just book a forward. Just call to the FX desk and book a forward. They don't need to do any paperwork, authorizations, etc. So it's much convenient from this perspective. Okay, so because that most of the time.
Cool. So moving beyond NDFs then, what other hedging instruments are popular in LATAM? So you mentioned forwards and options. What are the other, so forwards for short term, options as an alternative to NDFs? What other like hedging instruments are popular? And like you broke down there, right? You would use like a forward for more short term contracts, NDF for longer term. Can you also give like why you would use specific ones in the region?
No, for sure. No, a part of the NDFs, you have forwards, you have options, cross-currency swap, you are enable you to hedge also the interest rate differentials, and swaps, vanilla swaps. You have these 4 or 5 instruments. Again, each one provides different flexibility. Each one can be tailored to specific risky profiles. I think that the most of them. And we need to analyze. I think that a very solid hedging problem will depends on what is the benchmark of the company, what do they want to protect. I want to only protect my revenue. I want to maximize this. So it depends on the answer of the company. We can hedge just with an NDF or a vanilla option or some more sophisticated options strategies, or if I have a long-term debt with different interest payments, principal, I may use a cross-currency swap instead of place NDFs. If I'm in a negotiation, for example, let's say in the M&A situations, I have a specific deal. Maybe it's a local company selling some stakes for other offshore company or other business abroad, but I'm not fully certain if the deal will go through. Okay, I know there's a FX risk because I'm pricing my company in local currency, but the buyer potentially you buy the company using dollars or euros, so there's a currency risk in the transaction. No? But for example, I'm not completely certain if the deal goes through. If I hedge this exposure using an NDF, I'm assuming that the deal will go through. So I will have obligation at the maturity. Okay. So what will happen if the deal doesn't go through and the position be negative? I will have a loss and I will not have the deal. Okay, so the company will find itself in a big trouble. So the idea is to understand which derivative will be the best one for this specific situation. Maybe it's better just to buy a vanilla or option vanilla. So I have the right to protect against currency risk, but I don't have the obligation. So it's completely different story. Okay, so in this way, I can be protected and not have any collateral damage if the deal doesn't go through. Or I can use a deal contingent hedging, which is another type of structure. It's a structured product. Inside of it, deal contingent hedging, you have a plenty of forwards and options inside of this product. With the particular goal, if the deal doesn't go through, I don't have any obligation. If the deal goes through, I'm protected. Okay, of course, each one of the derivatives have their own cost. We need to understand this as well.
Makes a lot of sense, Matheus. I think you've touched upon it a bit earlier in this interview, but can you maybe break down for us how is Deaglo approaching the FX risk management space, in particular in LATAM, and with the various solutions available, what makes the Deaglo approach particularly suited for LATAM?
Certainly. Deaglo takes a holistic approach to FX risk management in LATAM. We provide a customized solution tailored to the unique challenges of the region, combining technology, for instance, machine learning, AI, Bayesian regressions, and very statistical approach, and with additional with your local expertise. Right now, we are building a very strong team in Brazil, okay? In order to be closer to our clients and potential clients. Our goal is to empower a business with the tools and knowledge they need to navigate in this dynamic FX landscape successfully. That is the main goal. For instance, throughout our FX risk management platform, our clients can gain access to market data, trends, analysis to make a more FX decision. They can use Monte Carlo simulation to model potential outcomes, incorporating different inputs such as volatility, skewness, amount, maturity to calculate potential loss, which is the value to risk. They can develop tailored FX hedging strategies and compare the performance of each strategy considering factors such as hedging cost and their impact on exposure. From the liquidity perspective, the collateral perspective, we can add the tools are able to evaluate the various hedging instruments, as mentioned here, NDFs, different option structures, cross-currency swaps, and so on. From the liquidity perspective, analyzing their collateral implications. So for those companies that it has lower liquidity in their cash flow, they need to understand the liquidity implications of such instruments. When we deploy our tools for the industry investment, let's say fund manager, institutional investors, we have created a tool that is able to compare different cash flows in terms of a cash flow with hedging and another cash flow without hedging, but looking from the IR perspective, looking from the performance of the cash flow. So we can assess the impact of the currency hedging on the fund's model's performance and compare cash flows with and without hedging. So what we are creating is a number of statistical tools that will provide more statistical insights, more data for our clients to take more informed decisions.
Yeah. Matheus, tell us the difference between the costs of hedging in LATAM versus other regions. Is it because of this complexity in this whole, the main takeaway I have from this whole episode is the complexity in LATAM versus other regions? Because you just have so many different economies that are doing very differently with different currencies on top of that. And on top of that, some of them are restricted and have very different currency policies as well. Is the cost of hedging higher in LATAM versus other regions? And if so, how do businesses manage that? How do you go about managing that from reducing?
Certainly, that's a very interesting question. Hedging costs in LATAM is influenced significantly by the interest rate differential, as I mentioned in the beginning. So making them relatively higher compared to regions with lower interest rates. Okay, when LATAM countries have higher domestic interest rates than those in major currencies like the US dollar or the euro, it can increase the cost of the hedging. Okay, so it's just so let's consider Brazil again as example. In recent years, Brazil has experienced relatively high domestic interest rates due to its efforts to combat inflation. Pretty much after the COVID pandemic. And so by 2021, the hedging cost to hedge the BRL back to dollar was 8.4%. In 2022, it was 6.7%. And currently, the hedging cost is around 3.6, 3.9% per year. Okay, why is reducing? Because for two many reasons. First, the Brazil Central Bank is cutting their interest rate, the Selic rates, recently. And second, the Federal Reserve is doing the opposite movement. They're hiking their interest rates. Okay? So the hedging costs are reducing because the difference is reducing between the interest rates. And you can use the same knowledge for Colombian peso, The Colombian central bank is also hiking their rates to curb inflation. Mexican peso, the same thing. Chilean peso, the same thing. I think overall, the overall economic situation in the globe is the same. But when you compare the hedging cost between euro and dollar, you see you not hit 80% as we saw in the BRL. This will be much lower, okay? Because the interest rates in both countries are much lower, okay? So when you have a higher interest rate in one country and lower interest rate in another country, you have higher hedging costs. I prefer another terminology to refer to hedging costs. I like to say hedging impact and not hedging cost. And why hedging impact? Because the costs you depend on the direction of the trade. Okay, if you are buying dollars and selling local currency, Mexican peso, Brazilian real, and so on, okay, that's a cost. You are against the curve. But so if you need to protect some liability in dollar, okay, you are against the curve. But if you're exporter, your revenue is in dollar, you need to hedge selling dollars and buying local currency. So you are the opposite way of the curve. So this is not a cost anymore. This interest rate differential is a positive carry. You have a pickup in your hedge, so you are able to maximize your revenue because you'll be converting much more, let's say, Brazilian real with the same amount of dollars. Okay, so I like to say it's a hedging impact, this interest rate differential, rather than a hedging cost, because it depends on the direction of the trade and direction of the protection.
And what can businesses do to minimize their hedging impact if they have to operate in between two regions that have a high interest rate differential? Are there any strategies businesses come to?
Yeah, first we need to understand the duration of your hedging. We need to understand if there are window through this interest rate differential curve that provides opportunities to hedge with a lower cost. So it's not because I have a 12 months maturity that I need to hedge straight 12 months. Maybe I can hedge 3 months and then roll it to additional 3 months and so on. Maybe doing this is cheaper than to hedge straight 12 months. Okay? This is one of the things that you can do to reduce the hedging cost. Other thing is to work with the hedge ratio. Okay, so the first question that we need to ask to those who want to hedge is what portion of your cash flow or your portfolio you want to hedge, you want to protect. You want to be fully hedged, means zero currency risk, or your risk profile will allow you to have some downside risk, but at the same time you have some upside participation. Okay, depends on the hedge ratio. So if you hedge 100% of your exposure, you have a higher hedging cost when you hedge 50% or 75%. Okay, that's another element that business can work with. What is the hedge ratio that will reduce my currency risk, but at the same time will allow me to manage the hedging cost. And the third one, I would say, work with options. Option strategies, as I mentioned in the beginning, is 3 components of the pricing: interest rate differential, volatility, and time to decay. Because they have 3 components, we are able to work with the options, analyzing the market conditions. So the volatility reduce, okay, I may have a cheaper hedging because the volatility reduce, or even though I have a high interest rate differential, the short term of the option might be cheaper than I place NDF, for example. So each case is a particular case. You cannot as I said in the beginning, we don't have all win answer for all situations. So we need to understand the market conditions, the risk profile, what if the client wants to hedge in order to reduce the hedging cost. Unfortunately, there isn't a free lunch. So we need to be very flexible, be very creative, work with these market conditions to take advantage of these components, and of course understand these tools. We need to understand these hedging contracts to be able to deploy the best hedging possible.
Matheus, thank you so much for that. That's quite an episode on LATAM, and we see much clearer about foreign exchange risk management over there. Is there anything you'd like to add in regards of the different topics we tackled that we didn't have the chance to touch upon maybe?
No, I think it was a very extensive conversation. We covered the hedging costs, the different hedging strategies, the volatility of these currencies in those markets. What triggered this volatility? We discussed the inflation, we discussed the actuation of the central banks, and also the role of the government to tackle the currency value against the dollar, against other currencies. So I think we covered most of the elements and most of the hot topics in LATAM when regarding hedging.
100%. And thanks a lot for that. Very cool. If people would like to know more about you, specifically your operation in Latin America or Deaglo, where should they go?
For more information on Deaglo and how we can help, how our comprehensive solutions for emerging markets, in particular for LATAM, I invite everybody that is listening to us to visit our website. It's deaglo.com. So there you'll be able to see our solutions, who we are, our team, how to get in contact with one of your FX specialists. You can send an email to us. It's Deaglo. It's info@deaglo.com. You can send an email straight to us.
Amazing. We'll put all the links in the description and also add your personal LinkedIn profile if that's fun for you, so people can find you easily. Matheus, thank you so much.
Thank you. It was a pleasure to share a little bit of my experience, and hopefully that will be very useful for everybody that is listening to us.